In today's video, I'm going to show you the concept of simple interest and how useful when you are applying it to business. So the meaning of simple interest or interest itself, it is the cost of borrowing money. Okay. So the cost of borrowing or use someone else's money. We're talking about the money that are being used when you need them. You need that access to banks. Okay. So you can access them to banks. You can also borrow monies from friends and relative members. Okay. So friends and relatives. Okay. So, and with the conditions that you are going to pay them back. So most of those money, when you borrow, they incur some costs. Either it can be cost of the interest, which we will talk about. So when you understand simple interest, you will understand if you're going to borrow someone's money, you will know how to pay it back, how much to pay it back, when to pay it back, and how often you are going to pay it back. Okay, so that's what the topic for today. So simple interest has a formula. Okay, so the formula for simple interest is that there's an interest payment, there's a principal that you borrow with the rate that both of you are agree on. Okay, and the two party or the two people in this role are the lender, okay, versus the borrower. Okay, so borrower. Oftentimes, the lender will set up the interest rate that the borrower can agree on, and you can negotiate the interest rate. If you go to the bank, let's say you borrow money from the bank, let's say the money that you don't own, it can be in the form of credit card, it can be in the form of like loan to start a business. The lender will set up the interest rate. They will offer you that interest rate. And you have, at that time, you can calculate what interest payment is going to be. Okay, so that's where this formula is very useful for you in the beginning. Okay, so interest payment equal to the principal times the interest rate. Let's say that you borrow $100 from the bank, okay? And the lender, which is the bank, set up the interest rate of 10%. Okay, so that is 10%. So you can put it into these equations to understand that, okay, at the end of the period, you are going to pay the bank back $10 in interest rate. Okay, so you have to pay them this much, plus you have to return the principal back to them. Okay, so the total payment that you pay back for the bank is equal to the interest payment plus the principal, right? So interest payment of 10 and principal of 100. So you're going to pay them $110 back, okay? Because when you borrow that $100, it is going to incur a $10 cost within it, right? Now, when we have the time factor included, we will spread those payments out, right? So let's say that if it's a $10 by the end of the year, that means each month you're pay $1, right? Now, let's get into some exercises. Let's do a simple exercise, right? This exercise is very similar to the example that I gave you above, is that you borrow a US bank at $2,000, a 6% interest rate, and the fine total interest payment you will pay at the end of the year. Okay, so we will rely back on the formula that we used before. So interest payment equal to principal times interest rate. Okay, so we just need to fill it in. What's the principal? We have $2,000. Okay, and at 6% that of interest rate. When we calculate that, it's going to give us around $120 by the end of the year. That's the total interest payment that we have to pay. Okay, now that's $120 is over 12 months, assuming that we borrow at the beginning of the year, right? So each month we will pay around, okay, so interest payment per month is going to be based on this formula, 2,000 times 6% and times 1 over 12. Okay, so that's $10. But you know you're obligated to pay the US bank $10 every month while keeping the borrowing money, the principal that you're borrowing them. And you can, for the principal, you can decide to pay them monthly, or you can decide to pay them fully by the end of the year. Okay, so let's say that you can do principal per month. If you're agreed to pay the principal per month instead of waiting by the end of the year, right, for the 2,000, you're gonna have 2,000 divided by 12, okay, with the interest payment per month. So it's going to be around $166.67 per month, okay, for the principal. So that means that you're obligated, if you agree with that fees too, you're obligated to pay $176.67 per month, okay? So that's how you return the money back to someone that lends you the money with the obligation, with their demand of those interests. So there you can see there's a cost in using someone else's money. Now, how do we put it into Excel, right? So as we know, we want to define something that we can do it by, instead of like by hands all the time, we can have a system that we can put it together. So the first thing you have to do is that you're going to set up the problem, like the principal, okay? Principal. And then there's an interest rate, okay? And you also have interest payment. Okay, so we are borrowing $2,000 from the bank at 6% interest rate. Okay, so 6%, and we are obligated to pay. The formula that we're going to use is 2,000 times 6%. That's 120. Okay, now there is a function in Excel that you can execute these problems, which speed up the process. Let's say you have to do with like hundreds of these kind of borrowing or loans from someone, or you're going to have to calculate it quick. I'm going to use interest payment, and I'm going to say it's method number 2. Okay, method 2. So what you do is you're going to use the IPMT function. So I stand for interest rate, and PMT stand for payment, right? And the rate that you're using is 6%. Okay, the period, we are looking for each period that we are having to pay the interest, and the number of period is 12 months. Okay, and the present value is the 2,000 that we are borrowing, which is the principal. PV stand for principal, and we pay them all by the future value at the end of the year. Okay, so that's the setup of the formula that you're using for this problem. And you can see that the interest payment for each period that you're obligated to pay is $120. Okay, let's do another questions to see the scenario when it changes. Okay, so is another questions. How much interest you have to pay for a 30-month loan of $5,000 if the simple interest rate was 11%? Again, you still use the formula above, but this time, be careful. This is a 30-month loan, right? It's not a simple 12-month loan or a one period loan that you're getting from the bank. So the formula kind of twitch a little bit. So you're gonna set up the interest payment, okay? Payment equal to the principal, okay? Principal times the interest rate, okay? Now I'm gonna add 1 to it. You have to time 1/12 period, and you have to times 30 months. So you have to add this part into your equation, okay? So what's our principal here? It's a $5,000 loan, okay, at 7% interest rate, okay? Now we know that each period we have to pay based on 1/12, and we time for 30 period or 30 months, okay? And that's going to give us around 888 times 0.75. Okay, so that's the additions adding to this. Okay, now if we put it into Excel, right? So I have a problem right here. How are we going to design this problem in Excel? So we still have the principal, right? So we still have the principal. We still have the rate. We still have the payment. Now, the principal is $5,000. Okay, so based on this exercise, you can see here, I'll make it smaller. And the rate, we have 7.11%. Okay, and the payment is going to be 5,000 times 7% over full period, right? That's gonna, and then you times 30, because we're doing a 30 period. That 7% is over 12 months. So we have to find 1 period. How much is it? And then we times the 30 periods afterward. That gave us 888.75. Now, we also have another method, right? Method 2, which we are looking to use the function in Excel, right? The IPMT again. In this case, we still have the rate of 7%. But remember, we are dividing it over 12 months, right? So it changes a little bit. Now, the period is we are looking to pay at each period, okay? And over 30 months, okay, over 30 periods that we are looking to date. Okay, and then this present value is going to be 5,000, and then the future value we're paying for. We can see that each period, oh, hold on, there's something wrong here. Let me double check here. And we have to times by 30 period. Yep. So the total payments that we have to pay is 30, okay? We have to times 30 because we are looking for a total interest payment at 7% for 30-month loan, right? So we want to know the total interest payment of those 30-month period, not only the 12 period that we are looking at. So that's going to give us the same amount, okay? So that is simple interest. There's another concept, which I'll give you in another video, which is called compound interest. Compound interest take into account of the payment of the last period principal. So it get accumulated over time with the previous interest and principal. And it's a lot more powerful than simple interest. Okay. So if you like this video, feel free to subscribe, and I'm happy to give you more in the future. Stay tuned.